Hello everyone. In this video we shall see the important 5 banking terms, financial terms. Okay, so these terms are important from main exam point of view and also interview point of view. Okay, simply if you attend interview, there can be a question, what is bank assurance? Okay, so pay attention, this is not K, this is C. Okay, what is bank assurance? Several times in several interviews, okay, questions like these were raised. Okay, what is consortium lending? What is overdraft? What is repo rate? Okay, this is part of monetary policy. Monetary policy is very important. Okay, from main exam point of view as well as interview point of view. Okay, we will discuss the monetary policy in a separate video. Okay, so first one, bank assurance, Demat account, consortium lending, overdraft. Okay, see, first one is bank assurance. Okay, bank assurance. See, bank assurance means, bank assurance is simply selling of insurance policies through banks. Okay, definition is selling of insurance policies through banks is called bank assurance. Okay, so if you face question like this, you can say selling of insurance policies through banks is called bank assurance. Okay, see, for example, this is an insurance company. Okay, insurance company, there are insurance products with this company. Okay, see, for example, this is bank. Okay, bank has customers. Okay, hundreds of customers. See, this insurance company will approach this bank. Okay, will approach this bank saying, sell our insurance products to your customers. Okay, sell our insurance products to your customers. Okay, see, because bank already has customer base here. Okay, customer base here. Now, what will the bank get by selling the insurance products? Okay, bank will get commission on each insurance policy. Okay, insurance policy sold by this bank. So selling insurance products through banks is called bank assurance. Okay, so this is all about bank assurance. Okay, whenever you come across bank assurance partnerships in newspaper, you will have to pay attention. Next point is Demat account. Demat account. Okay, so Demat account, it is used in stock market. Dematerialized account. Dematerialized account. See here what happens is, okay, in conventional method, for example, person A is there. He is the investor. He purchased shares of company X. Purchased shares of company X. See, company X, okay, the person A purchased shares of company X. He will pay money to the company X. In turn, company X will issue a share certificate in paper form to the person A. Okay, now what is happening here? Money is going towards the company. The company is giving a share certificate is in paper form. Okay, see here in Demat account what happens is, okay, same thing happens. Okay, same thing happens but in electronic form. Electronic form. See, whenever the shareholder, okay, whenever the person purchases shares, okay, purchases shares, in turn the company will issue share certificate. In Demat form what happens is dematerialized form. Okay, this is an electronic form. Okay, electronic form. This is an account, for example, Demat account. Okay, see, all the transactions, okay, selling and purchases, okay, selling and purchases are recorded here. Okay, so all the transactions are recorded in electronic form. For this, an account is used, that is called Demat account. See, company here, instead of issuing certificate in paper form, it transfers the certificate in electronic form. Okay, it adds the certificate to the account, that is Demat account. Okay, so this is used in stock market. Okay, this is dematerialized account. Okay, used for selling and purchasing shares in electronic form. Okay, this is Demat account. Okay, there can be a question at the time of interview, what is Demat account? Okay, so next point is Consortium Lending. Here consortium means group. Okay, group lending. Consortium means group lending. See, for example, company A wants to borrow 500 crore. Okay, 500 crore. Now, the company A has approached the bank, State Bank of India. Okay, now the State Bank of India, okay, to grant 500 crore, okay, it becomes a burden for the State Bank of India because the amount is very huge. Okay, if the company goes into losses, okay, if the company is unable to repay the loan, then there will be huge impact on SBI. Okay, so company A wants to borrow 500 crore. Okay, so it approached State Bank of India. Now State Bank of India forms a consortium. It approaches Union Bank of India, for example, ICICI. Okay, so for example, another bank X, okay, YZ. Okay, so all these banks, okay, in different ratios grant 500 rupee, okay, 500 crore to the company A. Okay, see, joining of two or more banks to give loan to the single borrower is called consortium lending. Okay, if the company goes into losses, then the effect will also be, okay, then the losses will also be shared by these banks. For example, 500 crore, okay, 500 crore, here UBI had granted 50 crore, okay, SBI 100 crore, another 50 crore here, another 50 crore here. Okay, if the company goes into losses, then the losses, okay, the company may not be in a position to repay the debt. At that moment, okay, there will be losses to the banks also. So losses, shares will also be divided. Okay, divided. So this is called consortium lending, joining two or more banks in order to provide lending to the single borrower is called consortium lending. So this is called consortium lending. We can expect a question. One is overdraft facility. See, very simple it is. Overdraft facility is given to certain customers whose credit worthiness is very good. Okay, so if the person's credit worthiness has already been established, then the bank may offer overdraft facility. Overdraft facility, if a customer has overdraft facility, then he can withdraw more amount, okay, more amount than what is there in his account. Okay, see, for example, person A has overdraft facility. Okay, overdraft facility, he has an account with ICICI Bank. Okay, ICICI Bank. Okay, now ICICI Bank has given the facility of overdraft rupees 20,000. Okay, see, this person can withdraw more, okay, withdraw additional 20,000 rupees than what is there in his account. Okay, for example, the person has 50,000 rupees in his account. Okay, in emergency he can withdraw this 50,000 and also plus 20,000, that is overdraft facility. Okay, overdraft facility. So the amount is specified by the bank. Amount is specified by the bank, whether it is 10,000, 15,000, 20,000, 50,000 or 1 lakh. Okay, the amount is predetermined. Okay, see, on the amount withdrawn, okay, on the amount withdrawn, the bank will impose interest rate. Okay, amount withdrawn by this person, okay, on that particular amount bank will impose interest. Okay, so this is called overdraft facility. Okay, the person who has overdraft facility can withdraw more amount, means specified amount. Okay, the amount will be specified by the bank. Okay, he can withdraw more amount than what is there in his account. So this is called overdraft facility. Okay, next one is repo rate. Okay, so several times there was question like what is repo rate. Okay, at the time of interview this is a general question. Okay, repo rate. See, for example, here bank A is there. Okay, bank A is there. Here customers. Okay, here customers. Now bank A, the bank mainly gets money from deposits. Another source is banks also borrow from Reserve Bank of India. Now, for example, Reserve Bank of India is here. Okay, see, bank A has taken a loan of 100 crore. Okay, 100 crore, a short term loan. Okay, short term loan is the loan which is generally repaid within 1 year. Okay, so RBI is there. The bank has taken a loan of 100 crore from RBI. Okay, now loan has granted by RBI to bank A. Now bank A has to repay the 100 crore loan and also interest. Okay, this interest is called repo rate. Okay, interest is called repo rate. See, repo rate means the rate of interest paid by the banks to RBI on the loans taken by them. Okay, here bank takes the loan from RBI. On the loan taken by the bank has to pay certain interest. That rate of interest is called repo rate. Okay, see, main sources of money for the banks are first deposits by the customers, and also banks borrow from Reserve Bank of India. Okay, so this is repo rate. Repo rate is the rate at which banks borrow money from RBI, that to short term loan. Okay, short term loan. So this is repo rate. So bank assurance, Demat account, Consortium lending, overdraft, repo rate. Okay, so these are very important financial terms. Okay, so make your own notes. Okay, just listening is not enough. Okay, prepare your own notes. Okay, revise them regularly so that it will be very beneficial for you. Okay, thank you.